Now we're into 23. Scott, listen, what we've said is, and what we think, the floor is now higher. The cost of capital has come down. Earnings not as bad as feared. But most importantly, the one thing we wanted to see the Fed toggle things down. The Fed hasn't pivoted. They've toggled things down. They're going from 75 to 50 to 25. And we kind of know when that end is. And since we have all these things, we think the floor is higher. And now we think you can sustain the gains. This won't be a straight line up, but we think things can be better. The reason for 2023 is that's when we think multiples really start to compress. That's when things get a little bit sloppy.
So I'm trying to figure out how so many different people can have so many different reads on what the Fed said last week. You know, there's this prevailing thought that they pivoted, that somehow that Powell signaled that we're near the end. And the market has ripped, for the most part, ever since and carried on this rally. Yet so many different Fed speakers have come out and suggested we did no such thing. And yet you're in the camp of the former. Where's the disconnect?
So we listen to what the Fed says, but what we really do is we look at the capital markets. What are the bond markets saying to us? What are we seeing? What's the curve saying to us? What's longer-term interest rates? What are Fed fund futures doing? And what are break-evens doing? And what we're hearing very loudly, or what we're seeing a curve inverted. We're seeing the back end come down, and we're seeing expectations for Fed fund futures also come down. What that says to me is, hey, we front-end loaded this. Things are working. Now we're gonna normalize rates, Fed funds, but we're going to do it at a slowing pace. In that environment, that's a very good environment for growth. As rates come down, the economy slows down, and inflation or break-evens continue to come down, you can make money from the growth side. We think a lot of the cyclical trades are over. You're too late in the cycle. Many of these companies are trading at mid-single digits, and the earnings you expect or the earnings that you see today are not the earnings you're going to get in 6, 12, 18 months. But it's what the bond market's saying is, the Fed's getting close to the end. And if you look back to that 1999-2000 cycle, it's very similar.
Are we talking quality growth or any growth? Because you could suggest by the move in, look, some of those higher valuation stocks from the ARC complex, which some question their quote-unquote quality. Everything's been going up. Does everything stay up, or do you have to really now discern between the two?
So Scott, a couple things. I think it was back in May, we took our short off of these high flyers. We didn't say these are the things we want to buy, but we think this could be a short covering rally. We think these things could do better. And they were down 45, 50% of that time. They were exceptionally oversold, right? But those are not the names. Those are not the core names we want people to get involved in. We want people to buy secular growth or fallen growth at a reasonable price. And you can get a ton of those names in the tech space, in the fintech space, in the consumer space. There's been a lot of pain taken on the growth side, and that creates opportunity.
All right. So lastly, before I let you go, this, again, pushing off what you say is, I suppose, the inevitable. Last time your headline talked about a soul-crushing sell-off. I think soul-crushing literally with the words that you used at that time.
That's right.
Is that still what's going to happen? It's just going to happen in 23? Or is it even when we sell off in 23, it's just not going to be as bad as you once thought?
No. So we're looking at 23, and we're really worried about margins. That's also the time when there's a lag effect to monetary policy. That's when the lag effect kicks in. Also, the consumer is getting stretched. The thing about the consumer, the great thing about Americans, we love to eat, we love to spend. But we don't stop spending until our credit cards get declined, right? We have the capacity to spend. The average consumer has the capacity. They're going to spend. But by the time we get to the first half of next year, that capacity is going to be pretty thin. And so that's when we start to have to pay the piper. That's when things get sloppy. And that's when I think we can retest the low.
All right. Good stuff. Chris Harvey, thank you very much for your point of view. I appreciate the time.